Welcome to the Movers and Shakers podcast, where real students are doing real deals in the world of multifamily real estate. I'm Vince Gethings, the owner of the Wheelwell Profits Academy. Listen in as we dive into the journeys of driven individuals who are turning their dreams into reality. These people are just like you, taking action and making things happen. If you enjoy the show, please like, subscribe, and if you're ready to take action, check us out at wheelwellprofits.com to learn more about our incredible community. Let's get started.
Hello and welcome to the Movers and Shakers podcast. My name is Gino Barbaro, co-founder of Jake and Gino, multifamily investor, educator, father, and mentor. Today's guest is Mohit Chopra, an engineer and project manager by profession. He ventured into real estate in 2013 and multifamily in 2020. Since then, he has focused on value-add properties in Ohio, North Carolina, and Tennessee, and successfully implemented our three-step framework across 7 properties, 6 of which have more than doubled in value within a year. And more importantly, Mohit is on a mission to increase his passive income and, not or but, and create better living conditions for his residents. Without further ado, welcome to the show, Mohit.
Thank you, Gino. Appreciate you inviting me to be on the podcast.
Listen, I remember meeting you at MM5, and you were out there and you were probably a little skeptical. Who's this Jake and Gino guy? And I'm not really sure. And what made you join the community? I mean, you've been doing real estate since 2013 and you had been in multifamily since 2020. What made you decide to join? And what were some of the benefits that you derived from joining as soon as you started joining?
So, yeah, I mean, you were right. I was a little apprehensive of the commitment as well, right? But
Yes.
meeting you in person, I have been having conversation with for maybe 7+ months in conversation in terms of joining. And I never felt the pressure. That was the one positive thing in terms of there were other groups that were really pressurizing in terms of joining now or, special deals and all that stuff. I never felt that. So that was a really good comforting factor walking into MM5. But when I met you and met all the other members, I had a lot of detailed discussion in terms of what the community provides. And then I got to learn more details of the basic framework. And I met the coaches. I think that is what changed my mind in terms of, yes, I need to join this, because I think the coaching of working one-on-one with folks who can drive you deal by deal as well and give you directional guidance on the basic frameworks of buying right. And even if you find the right opportunity, the right way to finance it and structure the deal, that was at that time I thought was a good value. It wasn't good value, it was a great value. I think I've learned a lot from that. We've done multiple deals, utilized coaches calls to go through the underwriting, making sure that we have done our due diligence prior and during the due diligence as well. So from my perspective, I I have no doubt I made the right decision at MM5, and it's been good so far.
It's interesting, Mohit. You use the word apprehensive. That's a nice way of saying I don't really trust these guys right now. I'm like, I'm not really, I'm a little bit on the fence. But you know what? It's one of those things where once you join, you've put a lot of hard work and effort into this. I always say this on all the podcasts with the Jake and Gino community members who really excel. And I think in anyone, in any program, it's not just the program. Obviously, we have an amazing program because of our coaches. It's not just Jake and myself. We have an amazing program because of the community members. There's quality people in this community. We have an amazing community because we've been doing it for years, and we are continuing to do it. We just closed on a 4-unit yesterday. May not seem like a lot, but 4 units is 4 more units. We closed on 300 last year. But what I love about you and what you said to me was, you've saved me from doing bad deals. Everyone thinks about getting into multifamily and running in there and having the get there right is, I need to do the next deal. No deal is better than a bad deal. Talk to the listener and tell them, how did you avoid making, I don't want to say a catastrophic, but it can be a really big mistake by buying that wrong deal. What did you do to avoid that mistake?
Yeah, so I was just going to start with that as well, because I think everybody gets real eye struck with the thing of like getting more properties or owning more properties, but I think the journey is a bigger piece of it, right? To making the right decision, and a part of the making the right decision is to know when to walk away from the deal.
Mm.
So this was actually the first deal we started working on right after joining JK and Gino. So and this is the reason I tell you the most value I got is from the deals that I've done, but actually also from the deals that I walked away. So this deal was a Class A asset, mixed use property in Columbus, great submarket. Um, but as part of the buy right criteria, if you delve more into that as to what's covered by the your framework, is also due diligence with regards to financials as well as physical. So the physical due diligence, everybody's aware of what to look for in terms of main criteria. And for Class A property, in most cases, physical due diligence is not going to create much issue. But it was the financial due diligence and some of the checks that and balances that we have in your courses and the framework that really helped us bring out the fact that there were some financial irregularities in terms of what was told in the OM and the spreadsheets that were provided to us versus the that were lease audit that we did. It weren't matching up. At that time, we had invested close to 10 to 15 grand in inspections and other stuff. We had about 60% of the capital raise committed as well. Um, but when we looked into the numbers, we went back to the seller, tried to talk to them and try to negotiate on the price based on what you told us it wasn't accurate. And what we see in numbers, this is the right price. And they didn't budge down. And we had to walk away. So we did walk away from that, and that deal never got traded. So
Mm.
that tells you like we were in the right direction. We were not wrong in terms of what our price point was. And but at the same time, you have to make tough decisions sometimes to walk away, because you would rather lose 10 to 20, 30 grand that you put in the deal so far versus losing millions later on when you are owning that property.
I love that. You've been on a great journey these last 3 or 4 years. Can you share with the listener how your journey of the buy rate criteria, how that's changed and transformed, and now all of a sudden wanting to become vertically integrated? That piece wasn't there a couple of years ago. Not having that epiphany. Let's talk about that a little bit because it's important. And I think, Mohit, the biggest epiphany that I've seen you've had is it's all of a sudden you're becoming a multifamily entrepreneur. You're seeing this as a business, not just as just an investor getting some capital, putting deals together, but this could be a really amazing, impactful business. Would you mind sharing with us?
Yeah, absolutely. I think it starts with the first piece that we have talked in the buy right criteria, like understanding what market you're operating in, right? And when we started operating in Ohio and North Carolina markets, we started building our bases there. And then recently we have had more success in Ohio because of the sheer volume that's available for trading there right now. And as part of learning experience, again, we have had our success and failures in terms of, no, I wouldn't call it failures, a learning experience when we've had to build our own team in terms of construction, in terms of repairs. But as we build our business, and at that time we started working with Jake and Gino and understood what first thing I got to understand more is what is I'm looking in real estate for, right? Like I know people think that real estate is sexy, let's jump in, let's invest, but what is the purpose? What are you trying to get at? Are you trying to look for long-term appreciation later on? Are you looking for cash flow immediately? What is the criteria? What is the metric that will drive success, or what will showcase you that this is a good deal for you? And not every deal is a good deal for everybody. So we decided again. You call it, and I really like that the way you call it, profit per unit. We call it cash flow per unit, right? And that is one criteria we look for as well. And as we delved into building our portfolio, we realized, yes, closing the deal is one aspect, but building onto the profit, there are two aspects to it. When you can either raise rent or you can reduce your expenses, right? And we are realizing as we have stabilized our portfolios that one of the easier and better ways to do that is to see how we can manage our properties better. Yes, we do our asset management. We go visit our properties every month, make sure they are performing well, and they're being maintained well as well. But more from operational costs, one of the components that we're looking for is how we can increase the overall NOI by reducing the cost factors. And one of them ties into, if we bring, now we have a portfolio of more than 100 units across within like a 5 mile radius. So what we are thinking of is bringing the repair and maintenance in-house, like hiring full-time maintenance person, because every time you send a plumber, they're going to charge you $150 for each repair. So you spread it across 5, 10 repairs that you have. That's more than what you will pay full-time person. And sometimes actually I looked at the numbers, actually 2 to 3, sometime in some months it has been 4x what we would have paid if they have it in-house. So that's kind of the next level of maturity in terms of understanding how we can improve the price per unit, right? So there's certain base work that we do as part of our underwriting, but as you get through, meet your targets, how to get to the next level. Again, I'm just trying to see what's the most efficient way to get to it, not squeezing too much. Again, we want to create a good environment for our tenants.
Mm-hmm.
I don't want to stop making repairs, because when a repair is needed because the tenants, this is their home. We just want to make sure how we can more efficiently manage those expenses so that we can get the same repair done, but it costs less to us overall.
This is important, what you said. There's a couple things that I need to extrapolate and really to pull out and to share once again. Real estate is about you. There are people out there who want to preserve wealth. They're going to go out and buy A assets. That deal doesn't work for Jake and Gino, and probably not for Mohit. Why would you buy a 2 or 3 cap Class A asset? Well, it's not going to create wealth. It's going to preserve wealth. So understanding what the asset and what the investment strategy is for you, and it changes with the market cycle and it changes with your maturity. And the other thing that I really want to pull out is don't wait to start. Because if you're thinking you need to have all the pieces put together, everything in alignment, if Mohit had said to himself, I need to have my property management, asset management vertically integrated and ready to go, he would never have started. But he said it's part of the journey. It's part of the process to learn as you're underwriting deals. And there aren't mistakes. There aren't failures. They're only learning lessons and opportunities to see what you've done wrong. And then you can pivot from that. And then you can come to the community, ask questions and say, how should I do this? And how should I do that? And then you learn from that. So don't be stuck with fear and say, I can't do this because I don't even know where to start. You start small and then you start and continue to figure it out. And multifamily is a team sport. Mohit's got a great team behind him and around him that helping him out. But there's one piece, Mohit, that I really want to jump into is you said you want to create better living conditions for your tenants. And I'm going to share with you our mission statement. We create communities that empower people to become the best versions of themselves, whether it's an employee of ours or a team member, whether it is a resident, whether it was an investor when we were actually, syndicating deals, or when it is a Jake and Gino community member. Any one of those, that's what we're trying to do. We're trying to create a great, empowering community. And for you, it seems as if you've noticed that, hey, your residents are your customers and you need to take care of them. What inspired you to put that in and to really highlight that?
So there are multiple factors behind it. One, I think that was one of the core principles that really connected with Jake and Gino, right? That's part of your foundational principles as well. And also it just makes more sense when we matured our portfolio and we looked at the attrition that we are happening or the turnovers that are happening before and after we put capital in improving the property, right? There is a substantial difference in terms of the quality of tenants that you get. If you put appropriate capital and create better living conditions, it's just going to attract better tenant base as well. And also, um, if the tenants are happy, you don't have to do every turnover. You're losing at least a month with turnover costs. You're having additional capital put in, at least even if it's for base paint job, right? You have to do that as a basis. All those additional from a business perspective also, it makes more sense to take care of your tenants in an appropriate way. Mm-hmm. Excuse me. What we have also utilized is we have also tested our markets, and when we go in, we go a little bit higher end in terms of the repairs that we do. We put stainless steel appliances, and in the LVP flooring also we go a little higher end on LVP flooring. The quality of flooring is a little better than what they see across in competing properties, and that also keeps the tenant more attracted to the property that we live in. They're more happy in terms of the quality of product that they get, and we have less turnover as well. And the last piece I would highlight here, like, I know most of the times we create higher end products and try to get higher end rents from the private pay. We also have not discriminated that against when we go for improvements, we improve all of our units across those assets.
Mm-hmm.
And some of those units are being rented out to Section 8 tenants as well. And yes, we have some negative predomination in terms of Section 8 tenants, but we have our checks and balances in place. We have the screening criteria very well defined. We have our regular inspections of the units that we normally do for all of our properties. And so far, I have had zero issue with Section 8 tenants in any of my properties. And we have received rents on day one for all the Section 8 tenants.
Mm.
It does take time. There's that one aspect that it does take time to get established, but once it's there, we have had good success. So in the end, I would highlight, as long as you take care of your tenants, you take care of the capital in a right way, it's a long-term benefit for you as well.
Mm-hmm.
Short term, you might have to spend the capital, but that's a capex, right? It doesn't impact your bottom line or NOI. But it does create a better environment for a long term. It's a long term game or thought process that you have to keep in mind as an investor versus a short term gain.
I'm not going to wait till the end of the show. I want you to share your email address right now, because if anybody's interested in your feedback on Section 8 and they want to say, hey, I had problems, help me out, Mohit. What am I doing wrong? Reach out to Mohit. And hey, I'm an investor. I love this long-termism. I love the fact that you're focusing on the customer. It's an underutilized investment strategy because the C tenant is often neglected, and we're trying to create the Chick-fil-A of customer service, and you're doing that as well. And I think anyone who's a limited partner who wants to invest in a deal, that's what they should be focusing on. Operators who understand who their customers are and trying to create long-term value for their properties. So what's your email address? How can they reach out to you?
Sure. It's Mohit, Mohit, at mvcapitalgroup.org.
All right. I love that. Reach out. I mean, if you're seriously considering investing and you want to get together with an operator who has experience, who's building an enduring organization, who's focusing on the right parts of the business, it's not just the buy right, it's the finance right, and it's the manage right, which is really, really important. And looking at costs, cutting costs down, but also making sure that he invests in his properties, making sure that he's delivering quality to his residents so they stay. Because an empty unit and a one that's turned over are two of the highest expenses that we can have. So building the customer experience and the customer journey is really important. Mohit, for anybody listening right now, how did you get started? And give people an idea, give them a couple of steps, what they can do after they get off the podcast and say, wow, let me get into multifamily. What should I start doing?
Yeah, I think it's a very common story among most of the real estate investors, right? Like, so you introduced me that I have the engineering background with an MBA as well. So I'm in a corporate role, been working 20 plus years, immigrated here when I was in 20s and went through the American dream of working in a big corporate, with the ambition to achieve success in the corporate ladder, right? Realizing later on that you are just one other, I guess, number in the big corporate that you work with, right? You could be anytime on the chopping block as well. So that kind of made me realize, and that's why the reason in 2020 is because we had those difficult times and a lot of attrition a lot of downsizing was happening. So it just kind of woke me up. I got to do something different. And at that time, I had just finished my MBA as well. So I had learned a little bit about real estate. I started out like most of the investors, investing small, single family home. Um, Went right into duplex and quadplexes, which we'll still consider residential family.
Mm-hmm.
And then started working and joined groups. Again, I think I was lucky enough to find the right people or join the right groups, including Jake and Gino, where I got the education first before I spent too much or took too much risk myself as well.
Mm,
So what I would suggest, yes, find good partners, people who are already successful. Give your time and effort, create value for them in terms of what you can do, right? When I did my first multifamily deal, um, my first partner again was very successful, and he's still a good friend of mine. It's part of another group, uh, and they came in because I found a good deal. It took me 7+ months to find a great deal in a tertiary market, but anybody can get that value by putting the effort and time.
mhm,
So you find the right partner, get the education appropriately,
mhm.
uh, and once you find the first deal, I know it's people say that, but it does create a wheel of success as well. You will keep finding more.
Education times action equals results. Take time, learn the framework, then start taking ask action. And I loved how you said understand where your value is, because your value may change over time. You may not have the money in the beginning, but you may have the sweat equity, or you may have the money and looking for somebody with sweat equity. And it really is a team sport. It's interesting that we talked about the deals you didn't do. Would you mind sharing a deal that you did do? Because I think it's great and all. People want to find their first deal. And Mohit, it's important what you said. We bought our first deal after 18 months of struggle. You were a lot smarter. You've got an MBA. You worked. I wasn't a smart dude. I was a pizza guy. It took me and Jake a lot longer. But after that first deal, ironically enough, 3 months after that, we got our second deal, and things started to fall into place because I think it is psychology. It's like, oh, wait, hold on a second. This is not that complicated. I mean, this is not hard.
Right.
I got to find some money. I got to find a deal. I got to put some systems in. Once you learn the framework, things start falling into place, and you don't have to do thousands of units a year. You could do 1 or 2 deals, nice deals for the next 3 or 4 years, and you look back and go, wow, I've got 300 or 400 units here. How did that happen? And that's what ended up happening with Jake and myself. So let's dive into a deal that you did that you focused on and you created that buy right, finance right, and manage right with.
Yeah. So I mean, like I said, we've done through the first one that we did was a totally different deal compared to the second one. So
Mm-hmm.
I'll start with that. The first one was a very stabilized property. It was just undervalued because the owner had owned it for a long time, but the property was in immaculate condition. So it's very rare to find those kind of assets where the rents are low and the capital is up to date, or the capex is up to date. So we found that, and that was lucky. I guess after 7+ months, I did find that diamond in the rough in a
It's
little.
not lucky. That's the thing. Everyone's going to say that's luck. It's not luck. It fell in my lap after 7 months. You were working hard for it. You found a mom and pop that didn't know what they had. So don't think everybody, oh, that deal. It's not rare. It's only rare when you're like, wow, I can't believe I found this. No, you found it because you put in the hard work and you knew what you were looking for and you knew the value was there. Those are a lot of components. I'm not going to say that luck doesn't play into it. I don't really believe in luck. I think the harder you work, the more you know, the more action you take, luck will follow. I mean, hey, I was lucky to find my business partner, Mike. Was I lucky? No, I just got into partnership with Jake. I had an opportunity. I knew the value that I could deliver to my business partner. My business partner knew the value. We were just able to meet at a certain time when we needed each other, and boom. I didn't mean to steal your thunder, but it's not luck. I just want to reiterate that for anybody listening, it is a component of putting in the effort as well.
No, you're absolutely right. I mean, I was underwriting at least 30 to 40 deals a week at that time.
Wow, that's a lot of
So,
effort. Yes.
so it is a numbers game. To your point, everybody says a numbers game. It literally is a numbers game. You start underwriting deals after deals. You hone in on certain areas. You know the market. You know the details around the expenses. You know how much the water is going to be per unit. You know how much the taxes are going to go up. Once you hone into those abilities, you can quickly underwrite deals. So I was able to do that. And then we found this one. And then after that, we found the second one, which was a value add, a little different. The third one was a totally different game. The second one was a little value add. The third deal was 3 out of the 16 units were occupied. Now, this is one of the biggest example I will share, Gino, that was the buy right, manage, finance right criteria comes in handy. And we are doing the manage right as well now. we bought this 16 unit townhome style unit. This is the other piece I really like. We love townhomes too, just like you guys, right? Um, and I have actual theory behind it also, data supporting that why townhomes are better. But again, like any asset class, the deal has to make sense. The numbers have to make sense. In this one, 3 out of the 16 were occupied, so you had more than 80% vacancy.
Mm-hmm.
Now, the reason it was because the person who was selling it had bought it in a really bad condition. They had done basic builder style finishing. We got it for 1.2, 16 unit.
What's the unit mix? What are they? 2 bedrooms?
2 bedroom and 3 bedrooms townhomes with garage. So we know at that time they were renting 3 units at 2 bedroom at 750 and the 3 bedroom at 950, which was way under market. Now, this is where the knowledge of the area comes in. This was on the cusp of the good area ending and the not so good area starting. But we know that we can create a product that will cater to the needs because it's at the edge of the good area too. It was really bad shape from exteriors. So the buy right piece comes in. We got a good deal. We got seller to finance a part of it as well. On a secondary. So we did put in quite a bit of capital as well as part of closing. Now, in terms of finance, right, everybody said I have to get a bridge loan. We were able to fight it out. We were able to find a lender, a bank, who not only gave us the purchase, 75% of the purchase, but they also gave us 85% of the rehab as well. So now we don't have a time clock on our head, right? So we are able to execute our plan. Now, just because we did the buy right at the right price and we had the financing appropriately, we had issues while going through the execution of the plan. Like, again, in most cases you will. In this case, we had two major issues. We had to fire not one but two general contractors because at that time we hadn't built that internal team, right? So this was part of that learning and building process as well, the growing pains, where two GCs we had to fire. They stole a lot of money in terms of they took money in advance. They didn't finish the work. We had to bring in second one. The same thing happened. And then we went in and we actually brought in our GC, an existing partner from Cincinnati area, different area. And we built our team in-house. And we finished that product. We finished the rehab. We have 100% leasing complete. I think there's only one unit left on that. We targeted 1,300 and 1,500 rent. We are getting 1,500 and 1,700 rent on that unit.
What do you think that asset's worth right now per unit per door?
It's after we lease out the last unit, it's going to be worth $2.4 million.
I need people to understand this. This is only a 16 unit deal, which will probably produce conservatively $300 per month in net cash flow. So 16 times 300, you do the math, around $5,000 a month in pure cash flow once Mohit has gone and pulled all of his existing capital out of there. So he's got a 16 unit desirable townhome style 2 and 3 bedroom townhome with garages that's going to be cranking out. One deal can change the trajectory of your life and the trajectory of your thinking, because now all of a sudden he's seen the value of bringing something in-house, going through those pains, getting punched in the face with the contractors. And I wish I could say, give me a show of hands, who hasn't gotten ripped off by a contractor? That's part of life. Even if you're not in multifamily, that happens to you all the time. That shouldn't stop you. But what you did was you bought the asset properly and you financed it properly. Great terms, by the way. Loan to cost. I love it. Jake and Gino community, we don't do bridge financing. We don't do the short-term crap, because if we give them back the keys like you see everyone else doing. But it's important. The reason why when you bought it properly, you were able to do the manage right. You were able to take a little bit of the risk off, because if you had overpaid on that asset or not financed it properly, you would have been under a time constraint and you would have failed on the deal. So, congratulations to you. One last question before
just one last, sorry, I would just have one more thing. I think, sorry, cut you off, but you're absolutely right. It's if we did not have that if we did not have finance right, we would be under right now because the bridge loan will be due and we are not done stabilizing. So again, it's up to us when we want to refi that property
Mm-hmm.
now. And the second point, you started the conversation by having the right team. So I would like to hear say that if I was on this deal by myself, I don't know how mentally stable I would be. So having a partner, being able to work through these challenges together, I think people underestimate the mental health and the toll on mental health in real estate as well. So having the partner to talk to, going through these issues, even just using the language that you have to in terms of getting through these situations, but getting back on track and having accountability as well, right? That plays a big role. I think people underestimate the value of that aspect as well.
Mohit, your shirt says Jake and Gino. If it had just said Gino, I probably would have quit years ago because it's like you're an entrepreneur, you're all by yourself. It's not just a real estate business, it's every business. And as entrepreneurs, I think we need to understand that it can be a lonely life. And you can go talk to your spouse, you can talk to your kids, but they don't understand the pain of making payroll. I've been making payroll since 1994. I'm the last person that gets paid, and that's painful. And you can't really convey that to somebody else unless they're in the same boat rowing with you. So that's really, really important. How did you find these deals? Give me an idea of finding these deals.
So most of my deals we have come through, I would say 60% of the deals have come through broker relationship. Even the two of the deals that came off market were pocket listing through a broker, right? So again, pocket listing is basically when the broker is not really advertising it across the entire world. They have their selected investors that they know will
Mhm.
close. And this is part of the puzzle as well. When you close your first deal, you build that relationship that you can close, right? They will come to you with more deals as well, similar to the one pocket listing I'm talking about. And we have had two or three from wholesaler as well. We have done deals with wholesalers, although I would say you have to be really, really careful when working with wholesalers. And we have been. And that is why I want to make sure that we have the buy right criteria well honed in and we know the market, we know the price that we're getting in, and we know the capex that we have to put in before we close anything with
Before
wholesalers.
you give out your information, I want to make this point once again. When Mohit was working and underwriting 30 deals a week and putting in all that work, it gave him the understanding and the expertise in that market so that when his first deal came, he knew without having to spend 3 hours that that was the deal. And when his 16-unit townhome came through, he knew what rents were. He knew what expenses were in the market. He understood that was his buy right criteria. So doing all that work on the front end, although it may be painful in the beginning, it really pays off in the long term. Now, if any listener wants to get a hold of you, they want to learn how to become an investor in your deal, they want to learn more about your strategy, they want to learn more about Section 8 housing, how can they get a hold of you?
Yeah, my website is www.mvcapitalgroup.org. My email is Mohit, Mohit, at mvcapitalgroup.org. And I'm on LinkedIn as well as Facebook and on Twitter as well.
Awesome. Mohit Chopra, coming from India 20 plus years ago as an immigrant, starts working the corporate dream. That's what everyone is taught, that's the dream. And for some people, it is the dream, but it seems as if the majority of the Jake and Gino community, it starts to become a nightmare because we all know that we're built for greatness. We all know we're built for something more. We all know that we want to build something for ourselves. And for some of us, that's the life that we want to lead, becoming an entrepreneur, becoming a multifamily entrepreneur. Mohit starts investing in 2013 in single family homes. He pivots in 2020. And like most investors, they start out with single family homes because of the limiting beliefs. They don't know how to get into it. But in 2020, he shifts into multifamily. And in 2023, he's at MM5. And he looks up, he meets Gino. He says, you know what? I'm going to take a shot. What's the worst thing that can happen? And 18 months later, he's on Movers and Shakers, talking about over 100 units. And the journey has just started for Mohit and the evolution. His life hasn't changed. It's just being transformed through multifamily and through the lens of looking at it from buy right, manage right, and finance right. Mohit, I want to thank you for being on the show, for sharing your story. Any final words?
No, I think thank you again, Gino, for having me on. I think, like you said, key pieces to the puzzle are in front of you. You find the right way to put value in terms of what you are contributing, find the right partner, do the hard work. And even though it's frustrating in the beginning when you don't have success, eventually you will get success if you continue on the
You
path forward.
will. Thanks, everyone, for spending part of your day with Mohit and myself. And go out there and make it a make it happen day. Take care, everyone.